Vinny, thanks a lot actually. In fact, this question is very relevant especially in the Indian context. In fact, given the fact that venture capital in India is relatively new, as you said, and interestingly, if you see, even from a regulator perspective, just about 2 years back, any fund, whether it was a private equity fund or a venture capital fund, was registered as a venture capital fund. So even if you are registering a 1,000 crore fund with the minimum investment of 100 crores, you would still be called a venture capital fund in India. So that was primarily because of lack of understanding and experience in the Indian markets. So of course, only recently even the regulator has understood, that there are different stages of investments. You have angel investors, you have venture capital, you have private equity, then you have real estate as an asset class, hedge funds. So there are different kind of investment classes. Now, from an entrepreneur's perspective, of course, there are multiple stages in a venture. You start with the idea itself. You basically initially look for testing your idea and try to go around talking to various people, especially friends and families. And if people believe in you as a person, and if they believe in the idea, typically those are your first bets. Those are people who would really want to write a check purely because they believe in you as a person. So I think that's the stage which is the angel funding or a seed funding stage, where you would typically raise maybe up to 1 crore kind of funding. That's primarily to get you off the ground and make sure that your initial running expenses, etc., are taken care of. Venture capital typically comes into play when you've already kind of done a proof of pudding, and in the sense that you already have some customers. Either you're in sight of revenues or you are already generating revenues. You may not be making profits, but you are basically at a time when you've taken a complete plunge into the business. You already have a team, and you started running on the ground, and there is a lot of seriousness, and now the basic idea is already tested, and there you start looking for anywhere upwards of $1 million, and typically goes up to even sometimes even $7-8 million kind of a fundraise, and that is typically called a Series A funding. And sometimes venture capital funds will also do Series B funding, which is once you've done Series A funding, then you basically look for another round of funding. If you typically need, let's say, $10 million funding, you only raise $5 million in the first round. Now you want to raise another round, so it could be in the Series B, which comes after Series A. Typically, private equity funds come after that, who would basically look for really businesses which are now proven businesses, where you're already profitable, and now you're really looking to from there onwards go to the next phase. And most of the times private equity players will look for a 3 to 4 year, maybe on the outer side, sometimes 5 years of time frame, and typically will primarily look for, even though there are obviously other modes of exits, but they would look for IPO as a primary mode of exit. In case of venture capital would typically look for a strategic sale, selling their stake to a strategic buyer, or selling the company itself to a strategic buyer, or to a private equity player, basically to get an exit. Similarly, an angel investor would look for an exit either to a venture capital or to a private equity when the next round happens. So basically that's broadly how, of course, the dynamics are very different at each stage, depending on the kind of business. If it's a technology-oriented business, then of course it scales up very fast. There's always a point of inflection which can really change completely how the business scales up. So therefore, many times, you will see very large funds coming early on, and really, wanting to back much larger amounts, but initially put in smaller amounts, but they know that very soon, as the business will take off substantially, you will have to really put in much larger sums at that point of time. So if it's a capital intensive business, like if it's a manufacturing business, or if it is a any asset heavy business, and there typically the growth initially might be a little slow, the return of capital initially might be lesser, but over a period of time as the business becomes more mature, it's a more, sometimes depending on the nature of the business, etc., it would have a very different curve as compared to a technology business. So really depends on what sector you're looking at, what kind of idea within those sectors you're working on, and therefore the size of investment could vary at each of these stages. So that's basically broadly to address your point.